The Chandelier exit is one of the oldest volatility-based trailing stop concepts in technical analysis, but most implementations stop at the basic formula. This version rebuilds it into a complete trend navigation system with adaptive filtering and structured trade mapping. At its core, this tool anchors a trailing stop level to recent price extremes, offset by a multiple of average true range, ATR. Rather than using raw price swings, the system calculates the highest and lowest points over a lookback period and steps the exit line inward only in the direction of the prevailing trend, a technique that filters out noise while still respecting genuine volatility expansion. Traders can choose whether this calculation references close-based extremes or wick-based highs and lows, changing how reactive the trailing mechanism becomes. Trend direction itself is inferred from price interaction with the prior bar's exit levels. A close beyond the trailing threshold flips the directional state, and the exit line then ratchets in the direction of that trend, tightening as price extends favorably, but never loosening prematurely. This one-way ratchet behavior is a hallmark of Chandelier-style trailing logic and is central to how the tool visually communicates trend persistence versus exhaustion. Two optional adaptive smoothing methods, a simplified Kalman filter and a slow-projected moving average, can be applied to the source price before extremes are calculated, allowing the sensitivity of the trailing mechanism to be tuned toward either responsiveness or stability, depending on market conditions. For additional context, the system layers in a higher timeframe EMA bias filter and an optional ADX-based trend strength filter, both of which act as confluence conditions before a directional flip is treated as a qualifying trend transition. This multi-condition approach is designed to illustrate how combining trend, momentum, and multi-timeframe context can reduce the influence of any single indicator's noise. Once a qualifying transition occurs, the tool auto-populates a full risk-mapped price structure, a volatility-adjusted stop-loss distance derived from ATR, alongside three sequential extension levels built on R-multiple spacing, 1R, 2R, 3R by default, fully adjustable. This visualizes how a fixed unit of initial risk can be projected forward into a tiered framework for analyzing potential reward-to-risk relationships, a core concept in position and risk management education. An integrated dashboard consolidates the model's real-time state, trend direction, higher timeframe bias, current ATR value, and a visual reward-to-risk ratio bar, into a single reference panel, reinforcing how multiple analytical layers can be synthesized into one coherent read of market structure. Educational takeaways *. How ATR-based trailing stops adapt exit levels to prevailing volatility rather than fixed price distances. How directional state changes are derived from price behavior relative to a dynamic threshold, rather than static price levels. The mechanics and trade-offs of adaptive smoothing, Kalman-style filtering versus slow-projected averaging, applied to price data. How higher timeframe and momentum-based filters can be layered as confluence conditions to contextualize signal quality. How R-multiple frameworks translate a single risk unit into a structured, tiered view of potential reward scenarios. The value of consolidating multiple analytical components into a single dashboard for faster situational awareness. Warning: educational software for analytical purposes only. Trading involves significant risk.